Welcome and thanks for joining us. My name is Clayton Bland. I'm the Chief Wealth Advisory Officer at CLA. Today is Monday, September 28th, and we've been showcasing over the course of the year what we're calling CLA Talks, where we welcome an outside voice to share an update on the market and the economy. Today, we welcome back Ann Sonders, Senior Vice President and Chief Investment Strategist from Charles Schwab. We really appreciate your time and spending this with us.
Thank you. Thanks for having me.
Yeah, you bet. So why don't we start off? This is going to be an exciting week. I think there's a big event tomorrow. I'm not entirely sure what it is. That's going to have a lot of people tuning in. But as it pertains to the market, you recently just put out a piece, and I'd love to kind of just start off talking about this phrase that you put in. It's an unwind in the market, or this simple rotation, or something more sinister. And maybe just kind of set the stage for that a little bit. If we think of some of the sectors within the market and in the economy that certainly are having phenomenal years, and then there's certain parts of the economy and the market that are struggling, and where capital has been going. Do you mind just kind of sharing a little bit on what you were looking at there and what your view is?
Sure. So, it's interesting. There are so many ways to segment the market these days. There's the cyclical versus defensive trade. Some call it the stay-at-home versus reopen trade. You can think of it in more segmented areas, growth versus value. So you really can segment the market in a number of different ways. But I think until recently, the narrowness in the market, particularly when both the S&P and the NASDAQ were hitting all-time highs on September 2nd, the dominance of just a small handful of names that was driving that performance. And I think that maybe helps to explain what I know is the number one question I hear all the time, which is the disconnect, perceived or otherwise, between what's going on in the stock market and what's going on in the economy, when the reality is, at least at that all-time high, which a lot of people were celebrating, if you look under the hood, all that performance was driven by a small handful of names. And I think that to some degree reflects, to your point, Clayton, that so far anyway, even though the economy is starting to recover, it is a relatively small handful of true winners and still a lot of uncertainty and in some cases carnage under the surface, depending on what industry you're in, what sector you're in.
So, specifically, there's a lot of focus on, we call it the big four. You got Microsoft, Apple, Amazon, and Google. And I think one of the year-to-date performance metrics that's somewhat, maybe not all that surprising, but there is that divergence. If you look at just the S&P 500 year-to-date, I think this is as of Friday, it was up 3.5% year-to-date. And if you take the equal weighted index of all the stocks within the S&P 500 and look at that performance, I think it's negative over 6% for the year. And so maybe when we think of this, the potential volatility, there's a lot of talk that people are saying it's have one view on, well, look, these tech stocks, this is reminiscent of 1999 and the tech bubble, or is it really this opportunity of high cash flow, strong balance sheet companies that are operating extremely well in the environment we're in? If you could expand maybe broadly within the opportunity per se, when we look at volatility risk, is if you're an investor, how would you look to measure what the potential volatility is going to be like from a market standpoint?
Well, I think this is, the subject of volatility, this is a particularly unique period of time in this particular year, given that it's an election year. You referenced something that might be going on tomorrow night that some people might have interest in. And that has had an impact to a more significant degree in an election year than what we have seen in the past. And I touched on the march to all-time highs for the S&P and the NASDAQ, largely driven by that small subset of names. As the market was hitting its high on September 2nd, the volatility index was also going up quite markedly. And that is an abnormal occurrence. Mm-hmm. Normally, when you're in an upward momentum-driven market and you're hitting new highs, volatility tends to be coming down. But what was happening at that time was the October VIX futures were also trading, and they were priced at a much higher level, pricing in the obvious election risk. Possibly and probably more heightened this time than your, standard garden variety election year. And that meant that the September contract, the one before that, had to catch up in price to that October contract. So that kind of explained the very unique thing that was going on around those highs. And I continue to think we're going to see these bouts of volatility, especially as we get closer to the election. Not every factor going on will be election related in terms of an impact on the volatility, but I think the election is particularly volatile. And as it relates to that small subset of names, there are a lot of valid comps to circa 2000, but maybe an important difference. And this is not, I'm not an advocate for these 5 names. I'm not an analyst. I don't cover individual stocks. This is not an implicit or explicit recommendation by any means. But if you think about, particularly when we were all in lockdown mode, how much time we were spending and arguably are still spending in the ecosystem of these names. So you started the question with, do we have to go through a significant period of weakness and volatility to sort of correct the excess in those names? I think you can do it without necessarily seeing the entire market come down with it. And that's because I think the fundamental underpinnings for a lot of these names are arguably stronger than what was the case back in 2000.
No, that's helpful. So if we take a look at the political risk, which is very difficult to have a recommended action item based on analyzing that risk, right? I mean, but I think it's fair to say it is difficult to predict whether or not the House will stay Democrat, if the Senate will switch over to the Democratic Party, and if Biden and Harris end up taking the White House. I think that's an outcome that would certainly, in most cases, people would argue when you get a shift where one party is in control, that will have a measurable impact. Right. But the outcome of that and predicting it is very difficult. So maybe rather than sitting here and trying to have a discussion on the political aspect of it, how about we focus on the policy from a monetary standpoint and really maybe share how little do investors really give credit to the impact of the Fed and what is perceived to be the backstop of the Fed? And then maybe if you could just touch on just help us understand what some of the risks are, either near term and long term, with the Fed continuing to be, an easy money policy.
Sure. So I think there is some underestimating just how forceful what the Fed did in this crisis was and the impact it had, not just on the markets broadly and on stability in the financial system, but into obviously asset markets as well. I think in terms of the benefit directly to the economy, I think that was a bit more on the fiscal side of things. Combined, of course, what the Fed did with various initiatives on the monetary side, including taking rates to zero, reinstituting kind of a newer, broader form of quantitative easing, as well as establishing some brand new facilities that didn't even exist the last time they pulled a lot of unconventional tools out of the toolbox for the financial crisis. But then you add to it what was initially done on the fiscal side, you add it together, and it amounted to about 40% of GDP, which is unprecedented in history, and caused a massive surge in M2 money supply. And the growth rate at the peak in money supply was almost 25% on an annualized basis. That's extraordinary. Now, the impact that had has so far been primarily in the financial markets, and not just the stock market. Markets across the board. You saw it in precious metals and commodities, right, even on the fixed income side. So this was not just to the benefit of the equity market. And the reason why it had maybe less of a direct impact on the economy is that, especially during the period where the economy was shut down, you had so much liquidity being pumped into the system. Well, if it can't be absorbed into an economy that is shut down, it finds its way into asset markets. Now, the rub of that is that in the past, and we saw this coming out of the financial crisis, we didn't see a lot of real economy inflation. In the last cycle, we had, although the longest economic expansion in history, the weakest. We saw great benefit to asset inflation, but right, not so much in the real economy. And so far, anyway, I think we're seeing some of the same thing. And then the biggest criticism, probably justified, is that in doing this, we're sort of mucking with, that's a technical term, traditional price discovery. And so I think that's one of the longer term implications. And then another longer term implication is that not that this was the purpose of what the Fed did, but given that asset owners are the beneficiaries of asset prices going up in an economy that is really hurting those that are not asset
Right.
owners, that are our lower end of the income spectrum, the whole sort of wealth divide has expanded in this environment. Again, that was certainly not the stated purpose of what the Fed did, but that's one of the consequences.
So if we look at a consumer-driven economy, do you subscribe to the belief that with the Relief Act and, as you perfectly described, the increase in asset prices of money finding a home, do you think from a consumer standpoint that 2021 might be a year where there is this pent-up demand, that there is a lot of room for the consumer and for Main Street if we continue, obviously, with a reduction in cases in COVID and the pandemic declines and we get a vaccine, that there's potentially the optimistic outlook could be this pent-up demand that maybe carries us through where unemployment can continue to decline and we actually have a surprise to the upside?
It is possible, though I would argue that we haven't been missing surprises to the upside, certainly not from a stock market perspective. And I think some of the initial recovery stats in the economy were really remarkable. And that's somewhat a function of the way the math works. When you shut an economy down and you compress economic data to such a significant degree,
right,
the percent increase off that bottom is going to look huge. I think the real question that I don't think any of us know the answer to that would help answer your question is the labor market. We've seen, obviously, better than expected payroll releases, a sharper and quicker decline in the unemployment rate. All of those are good. The problem is that most of the jobs that have been created, if you want to call it that, in this recovery cycle over the past several months were those on temporary layoff brought
right,
back to their existing positions. The problem is, as you've watched that line go down, if you look at it on a chart, permanent job losses are going up. And we continue to see bankruptcy filings and concerns on the part of small businesses. So if we can, and I think another fiscal relief package could help continue to build a bridge from shutdown era to whatever sort of the
right,
near-term future looks like, then I think you're right. I think there's pent-up demand, and I think the economy is probably fine. It's just I think we're still in a somewhat tenuous situation right now. Savings rates are high. They're about 18%. The question is, if the job market is not seen as robust, the increase in permanent job losses starts to play with the psyche
right,
of individuals. And even though savings cushion is high, they might opt to just keep that as a savings cushion and not turn it into consumption.
And that's really the discussion at hand between Mnuchin and Pelosi, and really trying to come together and say, look, this is everybody's trying to find a solution to keep
That's
people
right.
afloat, and let's
Right.
get to the back end of this where those permanent jobs maybe start coming back and we continue on with a recovery.
Right. And we have to also look at the fact that during the phase where we had the fiscal stimulus in full bore, where there was the extra $600 a week in supplemental unemployment benefits,
Right.
in that environment, if you broke consumers into two simple cohorts, one, the unemployed receiving that supplemental insurance, and then the employed who were obviously not receiving it, heading into that, the spending of the unemployed went down much more significantly. But in that period where they were receiving those extra benefits, that cohort's consumption went up much sharper and actually went to pre-stimulus levels, which was not the case for the employed. So it's an indirect way of providing support to the notion that consumption was certainly aided by that enhanced unemployment insurance, and that wasn't just a supplement that was saved.
Which was a good thing, which has been a positive effect. Yeah.
Absolutely.
So just last comment there, kind of looking forward, a large concern is, I think, when we look at asset prices continue to appreciate, when we think of the individual investor and a lot of the people that you communicate with on a broad outlook standpoint, there's there are a number of transactions that are still occurring. There are acquisitions that are occurring. There is money changing hands and liquidity being created. And this environment's created a bit of a conundrum, as it has been for the last decade, but even more so when you look at the available asset classes to deploy capital. And you think of what the opportunities are from a fixed income return standpoint, whether that's treasuries, corporates, agencies, even high yield, versus what opportunities exist in equities, and then maybe real estate is another asset class. But do you mind just sharing from an opportunity standpoint where clients look to it and say, I've got capital. What really makes sense to try and get a return on this capital going forward? And maybe we avoid the near term, but think of it as intermediate term and long term.
Well, I'm going to answer more broadly, only because one thing that drives me crazy is anybody that gets a question like that, or maybe even more specific on what should an investor's allocation look like between, equities, fixed income, cash, maybe alternative investments. And I bristle when I hear anybody answer that with any kind of precision.
Oh, yeah,
because
they know
it
for
depends
sure.
on who the investor is.
Right.
I could have somebody that came to me from the future and gave me a 98% surety rate that the equity market is going to do X. What I would tell a 22-year-old investor who just started investing and they inherited $10 million and they don't need it, and they don't need to earn income on it, versus say a 75-year-old investor who has a nest egg, they can't afford to lose any of it and need to live on the income associated with it. So I could have a single high conviction view of markets, but what I would tell those two investors are entirely different things. One thing I think we have to do better at educating investors about is, especially on the fixed income side of things, which is not my bailiwick, but I certainly understand the basics of. So many investors think purely of yield as the return. I mean, the reality is that this year, the total return, what investors have earned in total return in long bonds, is higher than the total return in the S&P 500.
Right.
So it sometimes is good to remind people of that and also actually show the data to help explain why diversification actually works. China is one of the best performing stock markets this year. So we have to dispel people of this notion that I think they had in recent past of the only game in town is the U.S. equity market and diversification doesn't matter. The other, I think, maybe not trick, but unique message we are imparting to our investors, those that are taking a disciplined approach, they've got their assets diversified across asset classes, and it's tied to their own risk tolerance and need for income and all of those factors, tax bracket, and is that oftentimes investors make rebalancing decisions purely based on the calendar. They'll do it at quarter end or at year end, where heightened volatility and bigger swings in asset classes can afford you the opportunity to maybe rebalance based on those portfolio drivers. And that just has the effect of basically keeping us in gear, kind of forcing us to trim into strength and add into weakness, and stay in gear with the market, as opposed to thinking that the only way to do it is to try to pick tops and bottoms, which nobody can do consistently well.
Yeah, that's a great point. We've had, I think there's two things there from our client base. We've been fortunate in identifying certain bands when you do have an asset allocation that moves outside of it, which would largely be a result of some market move. And that rebalancing has been very helpful this year.
Absolutely.
And your point, a pretty significant way in which we approach a client is really trying to understand not only their risk profile on what they can handle from a volatility standpoint, but really what's the time horizon of the use of that capital.
Right.
And that's you made a great point there. One of the other areas that this is somewhat of a legislation effect, though, that there is a lot of speculation on the change in tax rates, not just on earned income, but on capital gains, but certainly talk whether or not it really has a big enough impact on revenue. But the estate tax and really looking at this reduction, not to get into the weeds there, but when you think of that overall planning with a client and making those decisions, how much of the overall estate planning and tax planning considerations, kind of come into play when a client really needs to think about investing that capital?
Oh, I think it's significant, and obviously is also driven by time horizon as to the at what point that really is going to matter. Issues like the estate tax and whether you're putting together a plan that includes your will and inheritance and setting up trusts, all of those factors. And we're in obviously an acute period of uncertainty with regard to taxes. The only thing I'd say is, and you touched on it before when we talked a little bit about the election, is that even under a kind of blue wave scenario, unless the shift in the Senate is so significant
Right.
that you go beyond the filibuster rules, the
Yeah.
reality is that the ability to pass major changes to the tax code, I think, will be limited even in a blue wave, given the likelihood that the Senate is not going to go significantly in the other direction.
That's great perspective, because it's so easy to hear people's comments that just reach these drastic conclusions based on one outcome or the other. What's going to happen in the election.
On both sides. I mean, it's an
Yes.
election season. The bullets on the campaign platform. We've had instances on both sides where what was campaigned on as sort of the number one priority, that sometimes the reality of what's going on in the economy dictates what's important and what's
Absolutely.
not important. And we seem to forget that every time when we're in the throes of campaign season, as if, day one, the first three bullets, boom, they're in place. And it's just, the reality is almost always something quite a bit different. And the economy tends to dictate what politicians do, not the other way around.
Absolutely. And that's a great reminder. So maybe we're nearing the end of our time together. Maybe if we could touch on maybe some bigger trends. And this is something that certainly the work from home and what we've seen in this maybe advancement in corporate America of taking on certain practices that had been slowly evolving but just got accelerated incredibly fast to be able to operate. When we think of these trends, do you have some opinion when you look at it from in the companies that you speak to and just in your connections, this kind of reverting back to what was normal? And I think in particular, what I would want to hear you comment on is there's a frequent saying that you can get your job done in this new environment, working from home and remotely and utilizing this technology, but in really building a career, it's a challenge to see how that can really develop and process. So maybe if you could comment on that from a personal standpoint of people in their jobs, and then where you think it might end up going back to from reverting to normal, if you will.
Yeah, so I think in terms of how we work, where we work, I think it's going to be, the future is going to be somewhat hybrid. Of what it was before and what we're all doing now. And I've read some interesting long form kind of white paper reports on this, some from the perspective of the commercial real estate business, some from the perspective of Wall Street, some from the perspective of figuring out which industries can have a lot of their workers working remotely. And of course, many that are the most beleaguered industries don't have the ability. But I think the parts of corporate America that have adopted that, I think that the genie is sufficiently enough out of the bottle that I don't think we go full stop back to the way it was. I think the adoption of technology has allowed for some of the contact we have, whether it's internal meetings, things like this, can be done via video. The adoption of the comfort level across demographics is there, but it doesn't replace the benefit of in person, whether it's something like this, a client event. But I think absolutely to your point, you think about the young people who come in and they develop those relationships. But I think there are things that companies can do as well. We are really putting a big emphasis right now at Schwab on our mentoring program. And I'm a mentor right now, and I obviously have a mentee. And that was always done remotely because we're in so many different locations, but we're really figuring out the most engaging way to do that. So, and we're doing the same thing with events that we're doing for our interns. Right. So in the interim, try to make it as engaging as possible. We're all getting more creative and figuring out how this works, but I think it will be a hybrid model. A lot of interesting things I'm reading about companies who have been very singular in terms of where they're located in the interest of providing that greater flexibility, but also widening the net in terms of attracting talent and having a more diverse workforce, maybe more in the satellite location. So I think there's going to be a lot of creative ways that companies think about everything from their physical location to, okay, what types of meetings can still be done, through digital, and where is it most important? And we're all going to figure that out.
Yeah, that's great. Well, I really appreciate the time. This is great. We're going to have a very interesting week. We'll see what tomorrow brings, and I think we're just under 40 days until the election. So will be an interesting fourth quarter. So really appreciate the time. Thank you very much.
My pleasure. Thanks for having me.
All right. Bye-bye.
Bye.